So as I said previously, penny stocks lack liquidity. They lack a liquid market to buy and sell in. And you may say, well, how does that affect me? Why is that a big deal? Well, there's this thing called the bid-ask spread, okay? And even though there is a stated market price, and that's what you see on the ticker on CNBC or whatever business channel you may watch that has the stock tickers going through, that market price is not necessarily the price that you're going to buy or sell at. Every stock has a bid ask spread. And what that is nothing more than what individuals and companies in the market are bidding for the stock, so trying to purchase the stock at a given price, and what they are asking for the shares that they already have. And so obviously when you are at an auction, you bid up, right? So the bid is going to fall below the market price typically, and the ask is going to be above because you want to sell it for more than it's actually worth. And so what happens is when you as an investor purchase a stock, you buy from who? You buy from the lowest ask. So those individuals trying to sell for more than it's worth, you're going to buy from the lowest priced one of those. And then if you are trying to sell shares, well, who are you going to sell them to? The highest bidder. So you're going to sell at the highest bid. And so that's where this issue of liquidity comes in with penny stocks, because penny stocks don't have a lot of people, bidding or asking. And so if not a lot of people are bidding or asking, there's going to be a big spread between the bid and ask, and that can be problematic. So let's just use this example real quick. Let's say that a market price for a penny stock was $1. And let's say the highest bid was 90 cents, and the lowest ask was $1.10. So 10% above, 10% below. And let's say you look at the $1 price and you say, well, I think that this particular stock can go to 150. So that's a 50% return. I mean, it doesn't sound like a lot, but that's a 50% return. Well, what you're going to end up doing from that $1 price, you're not going to buy at $1 if you go to buy. You're going to buy at $1.10. So what you just did was you just cut into your returns by buying at $1.10. And then when the market price hits 150, you're going to sell, let's say the bid ask was the same, and so you're 10 cents below 150, so you're going to sell for 140. So instead of buying for $1 and selling for 150, what you ended up doing was buying for 110 and selling for 140. So your returns got eaten away. And it can be even worse than that. You can actually have a negative return due to the bid-ask spread if you're just trading based on the market price. And not to mention, you can be going to try to sell later and the bid-ask spread is much, much wider and much, much worse, and you can't find anybody to sell it to at an adequate price, and that can be an issue. So that's one of the reasons why I don't do penny stocks, and I don't see any reason that it would be smart to do so, because I want an efficient market, a good market like most common stocks have, in order to buy and sell as needed. Not that you should be buying and selling a lot, but when I do, I want it to be done at the price at which I see, or really, really close to it. Then this next point, we also talked about this. There's a lack of information, and I need and you need information in order to have some basis in order to invest in an individual stock. I've told you before, do not invest in individual stocks if you cannot do your homework, if you cannot find adequate value in that stock based on the fundamentals, based on the numbers. And with these companies, it's going to be really hard to do that for multiple reasons. And the multiple reasons may be that it's not registered with the SEC, in which case, good luck getting that information from the company. Or they are registered with the SEC and they're just so small and so do such a specific thing that it's hard to really determine, how they're going to make money moving forward. Or they don't have enough years of history in their financial statements in order to say, okay, well, this is enough time in order to determine what they will do in the future. And so all of those things can really play a part in saying, I don't have enough information. And if you don't have enough information and you try to purchase one, or you try to do some kind of trading in penny stocks, you're simply speculating. And that's not what we're trying to do. We are trying to invest that wouldn't be the case there. So you have to make sure that you have the information that you need, and it just really lacks with penny stocks. And then even further, something that I have left out to this point that has to be stressed is that penny stocks are penny stocks for a reason. You have to know that these companies are much more fragile and much closer to default on their debt or bankruptcy than the average firm is going to be. And so you have to beware of that. You have to understand that these companies, they have a reason for struggling to get public financing. They have a reason that not many people want to buy and sell their stock. If they were just fantastic companies, somebody would figure out that they were fantastic companies. And just a guess, you wouldn't be the first somebody to figure that out. And so that's a tough line to walk when you're trying to find good stocks that are trading below $5, because they are trading below $5 for a specific reason. And that's typically because they're not very good. And let's not forget to mention along those similar lines that when there's a lack of transparency with a company, what comes with that? An increased likelihood of fraud and an increased likelihood of dishonesty from the company, especially if they're not required by the SEC to periodically report. And so that can be a huge issue for investors if you're getting information that is no good. And so you have to be able to think about all of these things together with these small companies and be able to make a decision as to whether or not it's worth it to you to dip your toe into this place. But I generally warn against it simply because all these reasons compound. You put all these reasons together and you really find that it is so difficult to find good quality companies that are trading for below $5 that are going to make you a good long-term investment and a good satisfactory return over the long term. That's not to say that speculating in one won't give you a good, really great, maybe short-term return. But what it's saying is there was no basis for it. There was no reason. There was nothing you could have done to predict that there was going to be that short-term return. It was simply guessing. And so I don't want to guess. I want to have a basis for my decision making. That doesn't mean I'm always going to be right, but with these types of companies, you need more assurance because you have so many things working against you in the opposite direction, in the uncertainty and ambiguity, that you need some things to hold on to. And those things are information, numbers, and assurances from the company. And if you're not getting those things, then you simply need to walk away. And you may need to walk away even before you try to get those things, because this is just such a hard market to try to find legitimate long-term value.